Hi, everyone. Welcome back to our latest episode of the Growth Playbook. I'm Kim Clark, growth strategist and business coach, here with my dad, well-known economist and speaker. We are now in episode 2 of our podcast series, Planning for 2026 with Confidence. Last week, we talked about the fundamentals of using rates of change analysis and all the wonderful things that it will show you and how it can create confidence in your planning. And today we're taking it the next step further to talk about 2026 economic conditions and key leading indicators to be tracking and looking at, and really even just starting with what is a leading indicator, because a lot of the companies that I work with, they hear that terminology all the time, but just don't have the background to fully understand what it means and how to use it as a tool in their planning. So, Dad, really looking forward to all the insights you're going to share with us on today's call to help our listeners.
Happy to do that. And that's a great beginning because with a bunch of information coming at business leaders from all sorts of sources, you wonder which ones are applicable to me, my industry, and how do I use this? So it's a great place to start. There is a difference in the lead indicator you're going to use depending on where you are in the economy. If you're dealing B2C, you're going to be looking at a retail sales indicator, and ITR has a really good one of those. If you're going to be looking at B2B, there's another one. If you're into machinery, there's another one. I mean, there's all sorts of capacity utilization indicators. There's rates, which become the indicators. There's new orders trends, which are a leading indicator to the actual production needs. So if you're a producer of machinery or a producer of a part or of styrofoam, there are lead indicators that could be pointed in your direction. So part of the process, and you mentioned last week DataCast Essentials, part of that process is to find out which lead indicator relates to your industry and to your business, because it's not just one. Let me give an example of two examples. One is you hear in the media consumer confidence or consumer sentiment, and that quoted by lots of people. I just want you to know that's a perfectly useless indicator. Uh, it has the efficacy of flipping a coin. So don't bother with that when you're wasting your time. And another one that the media loves is to talk about employment. The unemployment numbers were disappointing, and that means the economy is going to, and they just, there's the end of the world's near because jobs aren't good and all the rest of that. And people think that that's a leading indicator. It's a perfect example of a lagging indicator. It can lag by up to a year. So it's like looking with really clairvoyance into your rear view mirror and knowing exactly where you've been.
Helpful as you crash moving forward still.
Yeah. So ignore those two, okay? Just start there. And the PMI, the Purchasing Managers Index, they're good people, and that's a good one. But when you just follow their monthly number, it can kind of vacillate and above 50, below 50, and you can kind of be, what's it trying to tell me? You make that into a rate of change, and all of a sudden you have something that's smoothed out a lot more. It's not perfectly smooth, but smoothed out a lot more. And you can use it more. The OECD has a US leading indicator, which is quite good. ITR has their own. So there are various leading indicators to use. So the first step is to find out which one is for you by actually seeing it and how much does it lead by. Pretty average, pretty normal to find one that leads by 6 months. So if you can see with confidence what the first quarter 2026 is going to look like now you got something to work with, right? Now you have a path that you can plan for and that you can work on. There's no one lead indicator that will always work with everybody listening, which is why I can't say follow this one. Life is just not that simple. There are some for the macroeconomic environment. If you want to know where US industrial production is going, there are three that are really solid that you can use. And US industrial production is made up of manufacturing, electricity generation, and mining. So if you're in mining, that's really much different than manufacturing. Electricity generation is different than the other. So if you find one that's really good for industrial production, but you're in mining, guess what? Doesn't help much. So even something as that sounds like it should work really good because industrial production is rather broad based, doesn't help that company, and you have to find out which ones work for you. So I try to be careful of the easy out. Most of the time I track with industrial production means most of this time this lead indicator can help you, which means most of the time you'll get it right. So am I happy with that most of the time? And the answer should be no. I can't afford the downside risk. I don't want to bet my chips on the economy slowing down when all of a sudden it speeds up because it's only right most of, 60% of the time. I need something better than that. You demand better than that as you get into this so that you can make those decisions. And correlations are what you use for that. And you get a correlation of 75%, you're feeling good. You get a correlation of 90%, you just want to marry it. It's what you need to get through life. So it's that much work, but it's that important. And as you accurately mentioned last week, the DataCast Essentials can really help you with that. It's a starter kit, anyways, as you go forward. You very often want to go deeper than the Essentials, but it's a great starter kit.
I agree on the starter kit, and I'm curious if we can even take it a couple of steps backwards for the folks on here that really just have no understanding of, just because they haven't been taught, leading indicators. So when you say that we can't list off here what's a good indicator for them to track, because it's going to be different based upon your business and where you fit. I gave the example on Ryan's recent podcast of the train, and where every rail car is a different business and segment of the economy, and you have to establish where you fit in that train to know what's going to make sense to be a good leading indicator. I was trying to think of a different way of saying it, but I'm just going to say those words for your business. DataCast Essentials is a great low-cost tool to helping you find a short list of indicators to watch. But how does it show you leading evidence for your business, right? You mentioned that you take the data set and you move it into rates of change, your data into rates of change, and compare the two, looking at the correlation. So if you have a correlation of 90%, you're going to be feeling pretty good about that. But how is the timing? So like, that's the question I get asked a lot. I'm like, so I have a good correlation to it, but I don't know like how far it's leading my business. And I know, again, ITR's DataCast Essential does this automatically where it establishes that timing between the cyclical highs and the cyclical lows, and then you can shift that market data set forward that amount of months in time. And that's still actual data. That's not a forecast. And now it's giving you an indication of a possible projected path for your business. And I'm just curious if you have additional ways of explaining that for the folks that are listening in, because I know that was a really foreign concept for a lot of my clients when I first showed it to them.
You actually explained it very well, Kim. It's a math function, and if you want to think of it in a non-computer sense, what you're looking at is the history of when did this lead indicator start moving up. 312 rate of change in this USLI thing started to move up. How much later did your 1212 move up? And manually you would list all of those, and you'd come up with, let's call it 20 cases. Well, you can at that point do a median, or you could do an average, but what we used to do is a majority range. Are those 20, you take a majority range. So you say, well, usually this USLI will lead from 6 to 13 months. The median is 8. And you're safe with that because you're throwing out the outliers. Outliers are generally that for a reason. And you have a usable. And I liked it when it was manual because you had this range. When you tell people it's 8, they tend to think it's 8. It's never just 8. And that's one of the problems with computers in a lot of things, is because it gives you an answer that you think is definitive, it loses its nuance. And no longer do they talk in majority ranges because of the way computers are. But keep in mind that it's a round date. And so when it doesn't happen on the 8th month, don't say this doesn't work anymore. It's only a round date. It's to give you an indicator, which is why, and I want to get back to your training in a minute, but which is why you never use just one lead indicator. You need at least three, because if you use one can lie to you at any time. But if you have three, you go with the majority, and unless you have a really strong reason for ignoring two and going with the one, which is not a path I usually took, you go with the majority. Now, I like your train a lot, because if you're in manufacturing of any kind, housing starts is going to be a good leading indicator for your business, because housing tends to lead. The financial markets tend to lead, and things follow that, and manufacturing's in the middle of the pack, and at the end of the pack is non-residential construction. So people in non-residential construction can look a year ahead or more and go, hey, I got a year to close as many projects as I can, and in 6 months I better start thinning my margins so I build my backlog so I'm still profitable while my competitors are going, what happened to all the work? And it's a powerful tool that way, that train. Now, within non-residential construction, though, you need to dig, because not all non-res is the same. Non-res can include apartment buildings, it can include office buildings, and it can include warehouses. So if you are a specialist in one area, you have to find leading indicator for warehouses and for whatever it is that you're doing. But it certainly is a great broad indicator. And if you're in the wholesale business and you just sell widgets that go into non-res construction of any kind, you don't care, right? You got your train, and that's all that you need. If you're selling something that's specific to semiconductor plants or Amazon warehouses, then you need something deeper. So unfortunately, it's rarely, not never, but it's rarely as easy as people wish it was. You can get that general sense from the train and be right, but you want to make sure that if you're a specifically focused company, you get the specifically focused indicator, so that you're not fooled by everybody taking a left while you're taking a right. Simple as that. And if I export a lot, I need to know what's happening on a global scene, right? I need to know what's happening in Washington too. Didn't used to, but now you do. And if I'm importing a lot, same thing. So there are things to watch that will impact your purchasing, your shipping costs. You can track your plan ahead for your labor costs. I mean, there are different ways of tracking the different components of business beyond sales and marketing. If you really want to get into it, it's incredible fun. Because somebody gets all excited and you go, no, that's not going to happen. You get to deflate people on a regular basis.
I don't know if everybody would say that's fun, but I'm sure there's plenty of people out there that would say that that's a lot of fun. It's nice to know what you can expect, I guess, is the way that I look at it too. Like, I'm very much a planner in my personal life, very much a planner in my work life, and I know a lot of other business leaders are the same way. It's nice to be able to go to your team and say, this is a plan and it's grounded in evidence. And what you were saying earlier and what we said last week on the episode with rates of change, again, it's still math. We're not talking forecasts at this point that are extremely complex, where you have to trust the source that you're receiving the forecast from. This is still a mathematical equation that's determining this possible projected path. Now, taking it back a step in my mind, because I'm just thinking this might still be somewhat overwhelming of, well, how do I find out where I am on the train? Yes, it's an analysis that, as you were just explaining, Dad, you could take time to use spreadsheets, Excel, and get data from online sources. You've mentioned a few sources already on our call. and do the work. All the business owners that I know don't have the time. They're too busy already working in the business and not on the business. And this, in my mind, would be considered more of a working on the business function that the leader should be doing, but just doesn't have the time to do because they're too busy in the business, which again is what Ryan is helping his clients with, is transitioning into true business owners working on business, not in business. But there are tools, and I know at least I feel like a broken record that I keep mentioning this, but I just can't recommend it enough. I feel that it's important enough to take the time and at least work with an online tool that can do these calculations for you. I don't know if there's any other entities out there that offer online tools, so that's why I continue to mention the ITR DataCast Essentials for the $80 a month. But to me, as a business owner myself, it's very well worth looking at the rates of change and then doing this analysis to see what headwinds or tailwinds are coming your way as you plan for the future. For all the reasons also that you were mentioning, labor, should I be concerned? Am I going to need to find out new things to launch next year if it's going to be a difficult year? And really just it gives you that runway to be proactive and really steer your business where you want it to go versus just reacting to being bounced around everywhere.
Yeah, absolutely. And it is something that can grow with you through time too. You don't start off with a full screen of leading indicators, right? You start off with the most important one, which will be sales. And then from there, you through time can grow into using leading indicators in other parts of your business. Because otherwise it's overwhelming. But you start with sales, which is where everybody should start, in my opinion, and you're going to find that you can expand it from there. Your own bookings, your own orders are a great leading indicator for your business. If you make it into a rate of change, you smooth it out. Now, let me add in here, this won't work for everybody. For people that have big one-off sales, and it occurs every 2 or 3 months, you get this big sale. This is not going to help you at all. It may help you with what your market is doing, but it won't help your company. So you can look at your market and know where it's going, but you're still going to be just dependent upon that big sale coming in irregularly. And there's not much we can do about that. As far as 2026 goes, the leading indicators, I looked at the Bureau of Labor Statistics and the personal real income. And this was information that I got from an advisory firm. And it was data that was sourced from the BLS. And what it showed is personal income is growing faster than the adjusted for inflation. It's above the rate of inflation. So people are making more money even with inflation. And as they're doing more, that means they can spend more. So as they're able to spend more, it means the economy in general is going to continue to grow. It's 2.6% above year-ago levels, and you get through all the math, it means there's enough going on. Now, what they're going to spend on is the next level down that we're talking about. But when it came to 2026, your question, one of the reasons why I can say it's going to grow in 2026 is the personal income. Real personal income is looking good. And the other one from another source, government, is new orders. CapEx is showing some life, and that's a large part of the economy. And as you have consumer sales and CapEx spending, and then you factor in the big beautiful bill, which has a lot of government spending. I mean, all the pieces are there to bring about economic growth. Now, a good number of the leading indicators, though, are not doing a V. They're doing kind of a sawtooth with an upward bias, maybe a mild rise, but unsteady, a lot of oscillation. That's pretty normal that there's oscillation. It's very rare that you get a straight line in any of this. But the mildness of so many indicates that we should not be looking for a wow kind of year. We're looking at, well, at least it's better than last year kind of year. And that's what the leading indicators can do too. They can tell you what the dynamic is likely to be when you take them as a group. So if you, to your train, if others are moving up at a pretty mild pace and the cars ahead of you, you shouldn't expect that when you get to the inflection point, all of a sudden you're going to zoom as
Right.
in the market. You may, because you're doing these things, the sales and marketing, but your marketplace is only going to do what the economy is going to give it. And the lead indicators help you with that, as well as looking at the industries ahead of you and how they're doing. Uh,
Yeah.
you're empowered at that point to make the right decisions, right? You get somebody saying, "Oh, we need to bring in four new machines at $1 million a piece." You look at the future for the next 2 years and you go, "Why? We should do just fine, you know, and we'll have surplus capacity in case I'm wrong. And if we get through 26 and it's stronger than we thought, we still have time to buy another machine, you know, so you don't lay out $4 million up front. You can start with two and then keep the $1 million hot off to the side if you want, so that then you can deploy it. The cost of the machine is going to go up a little bit, but you're going to earn more in the $1 million sitting off to the side. So you should be fine as you make the right quantified decision based upon the leading indicators and your own personal market trends.
Yeah, agreed. And thinking to the a lot of the clients that I'm working with, and knowing that I'm trying to remember the word that you and I mentioned I was using, sluggish. I think sluggish was the word that I had said, where it's still growth. It's just, it's not, this is an exciting ride. Put on my 5-point harness. It's going to be a crazy year. Um, and knowing that though, because they are again more nimble, like we talked about, and agile and able to enact change, a lot of our focus has transitioned into their market positioning. So that way they can look to how to steal market share, right? Like if the economy is only going to grant so much opportunity in their pockets where they're operating, well, then how can they position themselves as a better option in that space? As we go through the next 2 years. And that's where we're focused a lot right now, is that market positioning.
And that's the beauty of the size businesses that we're talking about and working with, is because they can do that. And corporate America has such a tough time with that.
Mm.
You know? And often the opposite can set in inside corporate America when in a small business, your local hardware store, you can walk in there and things are slow. So the ownership has infused them with a sense of energy, and every customer is important. You can walk into Home Depot and it's like,
Really?
I like Home Depot. They have a lot of good employees, but as there are less of them, or the mood inside the company turns less enthusiastic, it does impact employees. And in a smaller company, you can avoid that easier, and you can excite them, and people
Yeah.
respond to that.
Yeah, agreed. All right, so looking towards kind of what are our summary bullet point thoughts we want to leave our audience with on leading indicators. So we did last week was the rate of change or rates of change, and all the insights that's going to give using just even your own data. Now this week we've taken it the next step and said, all right, do that with your own data, but add to it these external data sets and overlay them. That way you can establish possible projected path based upon your relationship. You've touched upon 2026 expectations for the economy in general, where you expect it to be growth and reasons as to why, but not strong growth, and not we're on a roller coaster and headed up, getting ready to be on the wild ride. What are some other thoughts we want to make sure we leave with folks on this topic?
Um, just that mildness, for 2026, somebody else's industry can be totally different. If you're into data centers, you are going to have a great year. If you're into providing energy because you're part of the team that's uh, revitalizing 3 Mile Island for Microsoft, I mean, you're going to have a great year. So it always comes back to the individual company and what are you doing and what's happening around you. And rates of change are really powerful there too. Uh, that you can say, how long is this fun going to continue? And uh, that head on a swivel really is important to all sizes. I was just trying to be cautious that my forecast for 26-foot mile rise isn't taken as ubiquitous. It is broad, but it is not for everybody. Others will go down next year just because of the industry that they're in. Because in mile rise, it's not an average, but think of it as an average. So some are going to outperform, some are going to underperform, and every leader, it's incumbent upon them to know which side of that they're on.
Yeah, I love that. And I think this segues really nicely into next week's part of our series where we'll be talking market mix more and pockets of opportunity, areas to potentially steer clear from if you can, and just really the psychology of being in these different stages of the business cycle as we go through 2026. So I'm looking forward to continuing that conversation next week.
More fun ahead.
More fun ahead. We're having a blast. You in semi-retirement and having fun with me on the podcast. So
That's it.
I really enjoy them.
Well, have a good day, daughter.
Thank you, you too, and thank you everyone for tuning in. We'll see you next week. Please don't forget to like and subscribe and share any comments or questions that you have with us. We're happy to answer anytime.